So I would say probably one of the more popular, most used type of financing is what would be called accounts receivable financing. So accounts receivable financing is predicated upon a business-to-business type of transaction. So manufacturing company, let's say a manufacturing company selling to Honeywell or Boeing or even to a government agency. So as you're selling your product to your customers, you're generating an invoice. And so that invoice is sent to the customer, and the customer typically will have 30, 60, 90 days to pay that invoice. But in many cases, business needs that cash much quicker than even 30 days to pay their employees, to pay their suppliers for raw material. And so there is what is known as accounts receivable financing. What we're talking about today is really account receivable financing, not at a bank, but there are alternative lenders, commercial finance companies out there that offer account receivable financing to businesses. And so the account receivable financing will be predicated upon it's a lot of it is predicated upon who your customer is. Right? So you've sold something to your customer. If your customer is a Fortune 500 company, that is a much better receivable, and you'll get a better, what's known as advance rate, borrowing against that receivable, because the likelihood of that customer paying their bill on time is much greater if they're a Fortune 500 or Fortune 5000 company. And I would say even, government, whether it's the city, state, municipality, federal government. So accounts receivable financing is a form of financing that a lot of manufacturing companies, for example, who produce products that then sell to another business for an end product. Maybe it's a component of an airplane, or maybe it is a direct piece of equipment that's used. And so you have accounts receivable financing. And so again, a lot of that is based on who your customers are, what are the terms you give your customer. And again, the companies that will use that will be companies who are what we may call business-to-business type of companies.
Mm-hmm.
May
I ask real quick?
Go ahead.
Do these lenders take into consideration the length of time you've been working with this customer? Like if they've been paying you regularly for 3 years, you have this ongoing contract, versus it's a new accounts receivable account that you don't have a history with, and assuming that the customer is not a Fortune 500 or 5,000 company, but
sure, great
company.
question. Yeah, so absolutely. If and let's go out of the manufacturing industry, because let's say you're a professional service company and you're providing services to other businesses and you're creating invoices to those businesses. Maybe you're an accounting firm or you're a consulting firm. Same thing, you're generating invoices to another business. And absolutely, if you've had a relationship with that business for 2 years, 5 years, and even greater, and can show the lender, hey, this company, we've had this contract or relationship for 3 to 5 years. They've always paid us on time, never had a dispute in billing or anything like that. Mm-hmm. And so in that case, you'll probably get a better rate on the cost of the money that you're borrowing. And again, you're typically borrowing against your invoice so that you can pay your employees, your landlord, your day-to-day bills. And then typically the structure, Byron, is that when that invoice gets paid, it will automatically be credited against what you borrowed. And so you're borrowing against that invoice. Your customer finally pays that invoice. And there's different structures, different account receivable financing lenders. They'll set up a lot of times what's called a lockbox. And so your customer still has your name on the check, and that's the most ideal. Now, some lenders require, your name, XYZ Manufacturing, and then they require the lender's name on the check. So it's kind of a dual check. Mm-hmm. Other lenders, you will just have your name on the check, but it's sent to a PO box, which is what they call a lockbox. And then the lender controls the lockbox. So the lender then takes that check that came from your customer. It was made out to you. It came to the lockbox. They take that check. They apply it to your outstanding balance. Let's say they lent you 80 cents on the dollar. Mm-hmm. And let's say the cost of the transaction, the financing, is 5 cents on the dollar. So they'll keep, in that check that came in, they'll keep 85 cents on the dollar. And then they'll credit you back the other 15 cents on the dollar. Mm-hmm. So you've borrowed 80, your cost of borrowing that money maybe is 5%. And so at the end of the day, you gave up 5%, maybe it's over 60 or 90 days, to then get that money quicker. Mm-hmm. Right. So that's accounts receivable financing.